Hello there, it's me, Stephen Thomas, with Reports on Housing, with just yet another housing debrief. And I'm asking you to do just like this dog, please like and subscribe to our YouTube channel. It just makes sense. It really does, because this will get more and more people to engage in real facts, real data, that you can make great decisions based upon what's really happening out there, trying to cut through all the noise that's out there. This week, we're going to talk about housing is not about to melt. And this stems from Elon Musk has been in the press recently. Elon Musk warns house prices are set to plunge and says commercial real estate is in meltdown. Elon Musk rang the alarm on house prices and commercial real estate this week. Here's why he's worried about a property disaster. So from that, you can just imagine that all of the people that are all about the doom and gloom come out and they start to say the sky is falling. And there's a lot of noise that resonated from this. I heard it quite a bit. Even people were posting saying, hey, Stephen, what are you saying versus what everybody else is saying that's out there? So it's time to cut through all that noise and get to the real hardcore data and facts. But first, I'd like to thank our sponsor. Look who's back, my buddy, your buddy, Kevin Buddy at Monarch Coast Financial. And he, of course, deals with more than one kind of borrower, more than one kind of loan. And he has everything from full documentation loans to alternative documentation loans, investor financing, private money, loads and loads of experience. He's been doing this since 1976. And yes, you too can contact Kevin Buddy at Monarch Coast Financial. My buddy, your buddy, Kevin Buddy. Let him help you. 949-422-2075. That's 949-422-2075. Thank you for your sponsorship, Kevin. We really do appreciate it. Now back to the program. Commercial real estate is really what they're talking about. They're talking about commercial real estate. Elon Musk has some buddies that are into venture capital and that side of the equation, and that really is what their lane is. But now they're trying to talk about what's going to happen with commercial, and then they're also translating it and trying to say that it's also going to happen in real estate. So this is what they're saying. Commercial real estate, as a result of interest rates going way up at such a rapid clip, because remember, these interest rates are even closer tied to the short-term rate, which has ratcheted up from 0 to 5% in such a short period of time. It's the quickest on record since 1981. Now, the problem with commercial real estate is it's not like the residential space where you have a fixed rate mortgage for 30 years and then you pay it off. That's not what happens. A lot of loans that are tied to the business sector, commercial loans, are actually shorter duration, and they are going to mature. And when they mature, they're going to have to refinance them into something else. And also any kind of business loans that people get, they're typically shorter term, and then they have to refinance as well. So, but as we all know, that they get a lot of their capital from these regional banks. And the regional banks, there's been a lot of shakeup in there, starting with SVB and a whole bunch of other banks that have had issues. And as a result, the regional banks have had a lot of money that have left their vaults, and they've gone to the bigger banks. And people are diversifying, because if they have more than $250,000 in a bank, they feel exposed. So you're getting a lot of cash withdrawals and diversification in other kind of banks. So as a result, they're holding less deposits. And if you hold less deposits, you can't lend as much. So they've had to tighten their belts. So they have to scrutinize more carefully the prospective borrowers, and these rates are a lot higher as well. They only have so much money that they have to lend. So as a result, we're going to see the commercial sector break, and then it's just going to be a house of cards, and that will turn into a giant crisis, which as a result will cause a recession, and there will be massive unemployment, and then there's going to be panic selling in the streets of real estate because everybody's unemployed and they're all going to have to sell their houses, and we're going to have a housing crisis as a result. But this is where I step in. This is where I step in because I really want to peel back a little bit further than just talking about the speculation of why we're going to have this housing crash. And this is how a lot of housing crash channels and people that talk about a prospective housing crash, they stick to like one narrative, but they don't look at all the different data points and all the different economic charts and data and stats that go into properly making a decision. Really, you can't compare the real estate sector to the commercial residential real estate sector to the commercial real estate sector. It's like apples and oranges. And as far as the real estate residential is concerned, it's unfortunate that they're both real estate sector, but they're two totally completely different entities. We're talking about residential resale. Now, we're dealing with a real problem, and the problem is that we just don't have enough homes on the market. There are three different arrows that I'm utilizing here. The red arrow is when we had a glut of homes on the market, and this is for all homes across the United States. We had 4 million homes on the market, and that was prior to and during the Great Recession. Then post the Great Recession, during the expansion years of 2012 through 2019, I'm pointing to the most recent prior to the pandemic. That black arrow is pointing to 2019, and you can see just under 2 million homes. So on average, probably during that expansion period, a little bit over 2 million homes on the market annually, and that was the peak. Where we are at right now, the orange arrow is pointing to just over 1 million homes. So we have about half of where we were prior to the pandemic and a quarter of where we were when we had a glut of homes. The current level of homes that are available, you can ask any buyer that's in the marketplace, it just feels like there's nothing available. There's nothing out there on the market for them to purchase. And part of this is because of not the fact that everything's being scooped up and buyers are pouncing on everything that's available. They are pouncing on the few that are coming every single month. The issue is that a lot of homeowners are hunkering down because 71% have an interest rate at 4% or lower here in California fixed. And there are no rush to sell their homes. 89% have 5% or lower, and 29% have 3% or lower. And you can see, I just updated this today because now we're in another month. We can add another month. And right now, you can see initial COVID lockdown on the left-hand side. That was caused by COVID. Now, the higher rates is keeping people in their homes. They are very reluctant to move because they're enjoying these incredibly low mortgage payments on a monthly basis. And currently, there are 50,500 missing sellers January through May of this year for the first 5 months. What that translates to is over 100,000 missing sellers for 2020, all of 2023, based upon the first 5 months of this year. We're so far missing 42% of the entire inventory. And you can see the inventory right now at where we are today compared to where we were in prior years. Last week we were at 18,562. It went up 2% in a 2-week period of time. And let me tell you, that 2% was hardly anything. It's pretty flat for what we normally are doing at this time of the year. Prior to COVID. Last year, we were at 20,827. That's 12% higher than where we are. That's the orange line. It actually was gaining like crazy. It was going up at a significant rate. And we're right now not really going up much at all. Prior to COVID, the 3-year average, 2017, 18, and 19, we were at 38,677. That's 110%, which means double where we are today. And today, we're at 18,632. So, which is up, it's a fraction of a percent. So it's not even 1% when you round. And that's just, we're not building enough homes. The real issue is that by the time we get to where we peak out typically between July and the 3rd week of August, and most likely it looks like it's going to be right around August 1st that we peak. We're already in June. That's not a lot of time to grow, and our housing inventory is growing at such a low rate because there's not that many homes coming on the market. So we're dealing with this extremely low inventory currently right now. We could definitely use more homes. According to what they're saying is there'll be more unemployment, and then more people place their homes on the market. We definitely are starved for inventory, and we can utilize the more homes coming on the market. Now you pit that low inventory against a very, very low demand, and you can see where we're at right now. the demand levels is just a snapshot of pending sales activity. I look at the last 30 days of pending activity and look at that same statistic over time. And you can see this is where we're at. And this is actually peak time during spring. You can see where the other peaks are every single year, including last year was kind of a soft peak, but you can see prior years to that, to 2021 and 2022 were really high. But this is a very, very low subdued demand level, the number of pending sales. Pending sales is way down, which is translated to a very low number of closed sales, but that doesn't mean that the market's crashing and that values are going down. That is not what it means at all. And you could see in the Southern California demand statistic, the last week we were at 11,662, went down 2% in a 2-week period of time. Last year at this time was the orange line. It was actually declining from here on out at a very rapid, at a more rapid rate than what we're doing right now. 14,904, which is 28% higher. Prior to COVID, 17,782, the 3 years prior to COVID, 52% higher than where we are today. That's right around that purple line. And today we're at 11,503, which is down 1% from last week. So we are going down. Typically, this thing peaks during the springtime. It's kind of peaked right now, unless interest rates fall enough, where it encourages more listings, more homes to come on the market, which and then as a result, we would have more buyer activity as well. So the overall temperature of the market, how hot is this market? This is expected market time. It's a statistic that's unique to what we do, and it's based upon the available number of homes and current demand readings, not closed sales, but actually pending sales. So you look at that supply and demand, and we get expected market time. Place your home on the market. When are you going to go to pending status? So you can see right now where we're at, the lower the number, the hotter it is. And the only time that it was really hotter than where we are today was for a brief minute in 2013. And there are many, many markets in Southern California that are actually below where they were in 2013. And you could see during the COVID years of 2020, the second half through the first half of 2022, it was actually a little bit hotter than where we are today. But believe me, where we're at today is extremely hot. And today, it says today. Today it's at 48 days. Last year was at 42 days. Pre-COVID, it's at 66 days. That today was a snapshot of 2 weeks ago. Today, actually, if you take in supply and demand, it actually increased a little bit to 49 days. But still, anything below 60 is considered hot, and we know that there are multiple offers. We know that values are going up, and we're seeing it in the number of sales above the asking price. CAR did it; it's above 100% right now, or it just hit 100% for the month of April. When they do May, it should be even higher than 100%. And there are many markets in SoCal that are actually above 100%. So that's for this entire state of California. The Southern California, we just did that one. The lowest. Now, know that the overall housing market, what I'm describing is that it's the lowest average of leverage of all time. So the homeowners are not that leveraged as like they were during the pre-Great Recession days. Now, there's also record tappable equity. It's come off of its recent all-time record highs, but it's still record prior to COVID. We have a lot of tappable equity across the United States. People have been qualifying for a very long time with strong credit. They all have good jobs. Most everybody out there has great jobs. It is a very, very healthy housing stock. Now, remember, prior to the Great Recession, we say that you had a fog and mirror to get a loan, and that's not necessarily true because there were actually dead people. Their Social Security numbers were utilized to purchase homes. So you didn't even have to fog a mirror in order to get a home. So it was very loosey-goosey. There was subprime. There was pick-a payment plans. There was these teaser rate loans were like 2% loans, but you qualified on 2%, and then they would recast and down the road, and the payments would go way up. We don't have anything like that. The vast majority of everybody out there has fixed-rate mortgages or owns their homes free and clear. So when we go into the recession, which Moody's Economics calls slow session, I love this term, we're probably going to get interest rates that go all the way from where they are today, and they make their way down to this other range, 4.75% to 5.75%. Now, understand, when does this recession happen? We don't know. Some people believe that we're in one right now. I do not believe we're in one, not in any of the statistics that we're seeing right now. Could it happen later this year? Yes. Can it happen next year? Absolutely. And there's a lot of people who are saying 50-50 chance, 60% no, 40% yes. I'm in the camp that I think there's going to be a recession. It's just going to be slight, like what they're talking about here, a slow session. And it's going to arrive probably during the start of 2024. But who knows? Anybody's guess. You could throw darts at a dartboard and drink beers to figure out exactly when that's going to happen. But when we have that slow session, you have to understand that currently what we're dealing with right now is demand, where there are so many homes on the market. And that is only, there's not so many homes, there's so many buyers on the market chasing after the few crumbs that are available. There are not that many homes, and we have a lot of buyers that are bumping into each other, especially in the lower ranges. Luxury is a different story. Just did a report on it. But the United States 10-year Treasury, I want to tell you what's already happened since we had this debt ceiling. It's going to be rushed through the Senate today, and most likely it's going to be signed by the president this weekend. As a result of that the debt ceiling finally being resolved, the impasse coming to an end. Now, we talked about this last week. We actually have seen what's happened to interest rates. They were all the way up past 7%, and since then have come down quite a bit. They're tied to 10-year treasuries. You could see that range that we've been stuck in with the 10-year treasury. It's not going to go. It's been typically between that range until we had this problem with the debt ceiling. But now that the debt ceilings has been fixed, we're going to see this fall within this range until the economy slows more, and then this range will go down further from where it's at right now. Now, this is very, very similar. You can see where the interest rates were way above 7%. They actually hit a high for the year. And the last time we had seen it as high as it reached almost 7.2%, goes all the way back to November of 2022. But since it's just come down like crazy since we've had this impasse almost come to an end. It's going to come to an end very shortly, so that's good news. We have interest rates that came down to 6.85%. This range is 6.5% to 6.75%. We're making our way into that range, and that's where it will bounce around shortly. So as mortgage interest rates fall, especially further when the economy slows, not the 6.5% to 6.75%, but probably the 6 to 6.5%, and then when we go into that slow session, it'll go down even more. Demand will fall. So we'll have demand fall. And when demand falls, I'm sitting there saying the wrong thing. When demand rises, mortgage interest rates, as interest rates fall, demand rises. Excuse me, scratch that, reverse it. Let's back up a little bit. So as mortgage interest rates fall, we have demand that it rises. And you're wondering, why is that? Even during a recession, we're going to see a rise in demand, and that's because we're not going to see an onslaught of unemployed. That's kind of what Moody Economics means by a slow session, that we're going to have, things are going to slow down, but we're not going to see a giant catastrophic drop in employment and have unemployment skyrocket. We'll see more job loss, which will translate to all different sectors, from renters to some homeowners. But you have to understand that what will happen on the demand side of the equation is, as rates fall, home affordability gets better. And you can see it here that right now we were at 7% earlier at the beginning of the week. And now since then, look at where we're at. We're going to make our way down towards 6.5%. You can already see, if you want a $4,000 per month monthly payment, principal and interest, you're going to go from $751,250 to a $791,000 house. And then when we make our way down to 6%, you're looking at an $833,000 house. And if we get down towards 5.5%, we go into that recession, we're looking at an $880,000 house. You've done nothing at all other than interest rates have come down and have improved home affordability. And that's why you'll actually see more buyers enter the marketplace as interest rates continue to drop. It will also invite more for sale signs. Now, we have already said, if there are some more for sale signs that come around because we go into a recession, we're going to have rates that will be a lot lower, that will invite enough demand that will eat all of those for sell signs that come on, and we will actually, what we're seeing is a hotter market on the other side. Once we go into a recession, that we could actually have a hotter market because of the lack of inventory right now and demand increasing. So it can easily absorb more homes coming on the market because there will be actually more buyers in the marketplace. So you're going to see more sold signs as a result. So if we have more homes that come on and we have demand that is going up, it's going to translate to more closed sales, because currently we're dealing with like really low numbers of closed sales that rival Great Recession levels as far as closed sales are concerned. But I do want to leave with one more thing, and that is, and this is courtesy of Fortune. You can actually see, this is Case-Shiller. Case-Shiller came out earlier this week. I actually like Freddie Mac's home price index, but this was a great slide that actually shows you how right now we did go negative on a monthly basis, and that started for the country in July. In Southern California, it started in May. But you can see that that we actually are hitting positive months. The month of February is positive, March was positive, and based upon all the other metrics, Freddie Mac's home price index and Black Knight and a couple others, we're actually seeing that for the month of April that we've had a rise in values as well. So we no longer have values that are coming down, and that's because of how hot the market is. How I explained how there's such a lack of inventory with homeowners not placing their homes on the market, and the few buyers that are in the marketplace are bumping into each other. As a result, we're seeing a lift in home prices. So if you would like a copy of this, you know what? You need to be a subscriber to the Housing Report. Go to reportsonhousing.com, and you too can subscribe to the Housing Report and utilize the coupon code MELT. We have we just launched another housing report, and I invite you to like, subscribe to our YouTube channel. You'll get even more content. We're going to be sending even more. We're working on creating as much content as possible, and more bells and whistles for everybody that's subscribing. So go to reportsonhousing.com to subscribe. And I appreciate you tuning in once again. Hope you have a fantastic finish to your week, and we will see you on the other side.